Hey everybody, welcome back to the second half session of the live day trading room. It's currently 1:57. We're 2 minutes till we hear about the interest rate decision from the FOMC, and then we'll have a half an hour between where we'll have Powell be coming on at 2:30 to really give his guidance, and that guidance is going to be critical. So right now the markets have just been chopping sideways for the last couple hours, and we're just going to wait to see the reaction. The algos will digest this data a lot faster than we will ever. But we're watching many stocks, CAT, Boeing, China stocks, the S&P, Bitcoin, the dollar yields. Yields have actually spiked to the highs of the day, the 2-year yield. So that's interesting to see. So we'll watch the S&P, which it is climbing. We're going to flip it on a larger time frame because these moves are crazy. So we're just going to be watching the S&P. It is catching a bid here. So it is surging slightly, which is very interesting. But this is where we just sit back and wait. The S&P is getting a nice pop. Oil's remaining weak. The dollar's remaining weak. Natural gas is exceptionally weak. But the volume has been light. So expect it to increase. Feels very quiet.
Do you think the dissent is more
and
likely
eerie.
that people wanted 50 basis points or that people wanted to remove language that was more aggressive?
No, I clearly think there is a range for the terminal rate, and you see that implied by
S&P is
the projections
pulling
of
off from the highs.
projections. As we get closer to that terminal rate, you're going to see some dissent. Some people want to go further.
5 seconds.
People are going to want to pause.
We're getting
The
closer
algos
to
will
that.
digest
This
this
time around,
data.
It's going to be in the nuance that's going to be most important.
The Fed decision just moments away. Let's get some price.
The algos are digesting it. They're selling it so far.
Something like this on the S&P 500.
Initially, they bounce it.
On the Nasdaq, we're down a little more than a tenth.
Lots of jockeying back and forth. This is different programs.
Any moment now.
4.75
From
hike.
425, 475 on the upper bound, 450. So that is a 25.
The 2-year yield is surging.
The Federal Reserve. I'm going to bring up the
2-year yield is
just
surging.
quickly and work through this one, and then Mike McKee's going to join us. Here is the statement from the Federal Reserve. Recent indicators point to modest growth
25
in
basis
spending
hike.
and production. Job gains have been robust in recent months, and the unemployment rate has remained low. Inflation has eased somewhat, but remains elevated. They go on to say Russia's war against Ukraine is causing tremendous human and economic hardship and is contributing to elevated global uncertainty. The committee is highly attentive to inflation risks. They go on to say this, and this is probably the key paragraph, so work with me and I'll go through this verbatim. The committee seeks to achieve maximum employment and inflation at the rate of 2% over the longer term. In support of these goals, the committee decided to raise the target range for the Fed funds rate to 4.5% to 4.75%. The committee anticipates that ongoing increases in the target range will be appropriate. So that line sticks. It goes on to say, in order to attain a stance of monetary policy that's sufficiently restrictive to return inflation to 2% over time, in determining the extent of future increases in the target range, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects activity and inflation, and economic and financial developments. In addition, the committee will continue reducing its holdings of Treasury securities and agency debt and agency mortgage-backed securities, Lisa. As described in its previously announced plans, the committee is strongly committed to returning inflation to its 2% objective.
I would say that this is a Fed holding close to its vest, but I think you pinpointed.
Just heard the statement from Bloomberg by the Fed. So thanks to Bloomberg. UNG's dropping. So it just made a new low. Generally when you make a new low in the trend, you catch a bounce. Since it's so beaten up already. We're still in a UNG trade here. We're going to pick up some at 620. At 620. And it's the Boil, B-O-I-L. So realistically, the markets haven't moved yet. The SPY is just trading in this range. Chopping up and down. Still seeing weakness in natural gas. Dollar's trying to perk back up. Yields are trying to perk back up. Stocks like Hess that have been market leaders and MRK have been weak. Bitcoin's trading at 23,114. Apple's around 142, just breaking that level. Apple's looked weak all day from a technical standpoint. There's been sell pressure in Apple all day. And ultimately, we have to always respect Apple because it does carry that index and market cap weight. So I'm going to pick up some Boil at 620. And this trade I will hold overnight. We're already in a trade, but the spiders are kind of selling off right now around to 403. So right now I am long Boil at this 663. I have a 4-6 position. My next add level is 620 and then 6. And again, I will hold this trade overnight, no matter what happens here with Powell. Natural gas at these levels, it's funny how the markets work. Everyone wanted natural gas at 9, 10. Now no one wants it here at 250. But keep in mind, Boil's the times 2 ETF. So I'll watch Boil on my other screen. Let's just see what the markets are doing. Obviously with the SPY, it's really created this bear flag pattern that looks vulnerable to break. So could this pattern be telling us that Powell's more hawkish? You know, we're speculating here, but we have to respect the technical pattern at this point. And let's see what the dollar's doing. Boom, boom. Trying to recapture that breakout. Nice surge. Let's take a look at the 2-year yield. I think the bond trade is too crowded. I think, yes, it's a good opportunity, but I think there's going to be potentially a little bit of capitulation before the right opportunity. I think we see the 2-year yield jump back up to this 4.5% mark in the near term, especially if Powell's the one who could only have the power to do that. But if that does, that's a big, big implied move in yields.
Where the balance of risks is and going too far or not enough?
Well, I think they're more than willing to actually look at the economy and saying where we are today, they're more willing to risk overshooting than undershooting. And the reason for that is that balance sheets have healed dramatically from where they were, not only household balance sheets, but corporate balance sheets. And that's why they're so worried about financial conditions offsetting and moving in the opposite direction of where they're going, because it actually could not only undo the progress they've made on inflation, but actually trigger more inflation. And that's something they're very concerned about, is that we're now in an economy.
So the press conference is going to be in about 25 minutes. That's going to be a real market moving event. Pretty much this is a nothing event. Had a little bit of chop, a little bit of drop, but it's a nothing event for the SPY, but right now it's not a nothing event for the DXY. So look at this surge, and the markets haven't reacted. So let's keep in mind that the dollar did confirm buy signals, which is why we are long. This is not financial advice, but it's impressive to see the market's not reacting really yet. And like I said, we did confirm the breakout on the hourly chart as opposed to these previous 4 other attempts at breaking out. So will we recapture this overall uptrend and continue higher? Time will tell. Time will tell. How about we look at what Tesla's doing? Tesla's still holding up really strong. Tesla's still holding up really, really well. Near the highs. Wow. So we got a pump going on CVNA, Carvana. Let's see if we can get a short level on this bad boy. Vroom, vroom. Markets are actually running up now. Spiders are pushing.
Move the finish line when they're battling inflation. They've got to cross that finish line. And when they come back and reassess what is the appropriate inflation rate after the
the S&P is just trying to grind higher. Dollars pulled in and yields have pulled in. But we are pushing up across all sectors. Oil hasn't responded really that well. Natural gas is slowly catching a little bid, as seen by our oil trade here.
What they did over the past year.
Energy stocks still remain weak. Excuse my alerts. This thing, I've set hundreds of alerts and they just appear. Let's keep looking at the S&P because we are at the highs. Impressive reversal on the S&P. Just tune into Bloomberg.
About how long it takes the cumulative effect of policy to bake in. So yeah, some of it gets baked in faster. The interest rate sensitive sectors are slowing. I kind of think the remainder of it is still in front of us. We do think the consumer will face more headwinds as the year progresses. So something in the second or third quarter might be when most of the weight of prior tightening shows up in consumer spending. So I don't think we're there yet.
You'll excuse me for being somewhat impatient, Dan, but if you'd asked me back in August whether claims would be at 186,000 at this meeting, I would have said no, probably not, and they'd be going in the other direction. So is there anything to learn from that?
It's really been amazing how stunningly strong the labor market is, and that's why the Fed has it in their target. And I think that's what's so hard about where the Fed is standing right now, but they certainly are not willing to back down. The fact that the labor market is where demand and supply is now the most out of line is important. We're talking about 1.9 job openings per job seeker in the month of December. That's close to the record highs that we saw in 2022 when wages were accelerating. Also important is that 8.7% increase in Social Security that Mike mentioned. That's really important because that's $8.9 billion in cash that 66 million, at least, consumers got in January alone. That is a very important amount of cash that is all likely to be spent. And from the spending data that he just mentioned, they are spending it. That is likely to be on services and necessities and put, again, an additional reacceleration in inflation in play. And that's what the Fed is worried about.
We're looking at markets that initially sold off, that stocks sold off. Bonds did as well in response to the statement. The NASDAQ has reversed, interestingly, as people parse through this, which, John, I actually find pretty interesting. It's sort of the market wants to go up regardless. It was, multiple hikes, whatever. Okay, let's go up. Things are good.
There's a lesson every time the Fed meets. It's never spin too much of a story just before the news conference starts. It's kind of like the earnings reports, right? The earnings come out, you wait for the call and the guidance. And I think on Fed Day, Tom, it's kind of the story with the Fed too. You get the statement, okay, hands off. Let's see what the chairman's got to say in 18 minutes.
You nailed it. We're addicted to the guidance. And in the defense of everyone, why aren't they giving us guidance every meeting? I mean, it can be lesser guidance. I get that. But there's sort of a vacuum here to move on. I'm sorry, I don't have these memorized, John. I'm trying to. I took a quiz and flunked. March 22nd, May 3rd. When does this get important again? I don't have an answer.
So if we had the
June
statement
14?
today, Tom, alongside a summary of economic projections, Dan, I think this is a question for you. Dan, if we had that SEP today, how do you think it would evolve relative to what we got in December?
Good question.
I actually don't think it would change as much as people think. We have those doves rotating in. We had a lot of people talking about maybe a pause in rates. Patrick Harker, who's a voting member of the Fed now, Lori Logan from the Dallas Fed, who's a voting member, Austin Goolsbee is now a voting member of the FOMC at this meeting as well from the Chicago Fed. All new voting members, Neil Kashkari now on the other side, who used to be a dove, now very hawkish. I think it's really important to understand that the data we've just gotten in the last couple of days actually hardens the Fed's resolve. And Chairman Powell went out of his way to say that there was no one who had a rate cut priced in December in the SEP when he talked about it. Now, Chairman Powell doesn't really love the SEP. It's something that's been sort of a thorn in his side at times. But I think that was very important guidance that he gave, that no one had a rate cut for 2023. The Fed really wants to hammer that point in. And even though we have some doves on the Fed, they're going to be relooking at the data that's just come in and say, you know what? We should stick to where we are. Stay the course is what we heard over and over again. This is going to be a very hawkish description of that meeting. And I don't think there's as much debate as many people thought was emerging. I think that just got quelched by the data we've seen.
And Mike Apen, your thoughts?
So I would agree. I don't think the SEP would have changed.
All right, so we're back here just listening to a little bit of Bloomberg, but also watching the S&P. It really hasn't moved much. You had a drop, you had a pop, but you're coming back inside of this range. And same thing with the yields and the dollar. They've coming back inside the range.
Change the effect of that, right? So if they really, really wanted to push back again.
Now we are still in a long boil, and we're looking at potentially shorting Carvana. CVNA is the ticker. Let me just try to isolate down a level. So I'm going to short Carvana, a trade. I'm going to look to short Carvana if we get a pop into this 1438, 1439 level. That's kind of what I'm looking at. I'll have some double pivots up here. 1580. It's high risk. Super, super high risk. But that would be a massive pop. I mean, it's appealing right here. It is appealing, but again, it doesn't provide the same risk to reward setup. So you can see it right at that gap fill pivot. Spiders are coming in, so potentially does favor a move down. Powell might crush these assets because they've seen him run like crazy, Lucids and all these gambling stocks today. And one thing we have to keep in mind about Powell is the market was anticipating a 0.25% hike, which is what we got, but the unemployment data was brand new this morning, and that came in stronger than expected by a long shot. So we always have to keep in mind the two mandates, unemployment. Obviously, many people say price stability, which, yes, I agree with. There is price stability that he worries about, but it's ultimately going to be inflation. That's his one mandate, and employment, maximizing employment. At this point in time, he's expressed he wants to create unemployment, and he's going to push harder. I think he's going to push harder just based off of this data that we got today. He's going to keep falling back on the unemployment data, which is always the lagging data, always lagging. So that's why we have to keep in mind that these markets are still vulnerable at any point in time, because the lagging data that the Fed is looking at is lagging. It's coincidental data. So until that catches up and really shows weakness, we could be in dire straits. And that is why our system is always has these boom and bust period, because the Fed looks at lagging data when it's often too late. They break something, but we're designed to overshoot in both directions, to the upside and the downside. And anything in 2020 and 2021 was clearly an overshoot to the upside. And to really get back to that 2% inflation rate, which I don't think we're going to get to, we have to drop substantially more in asset prices and really have, right now we're going through disinflation, where inflation is coming down. But in terms of deflation going negative, that's a bit of a stretch right now. You still got to dump that balance sheet, which the last tightening cycle only saw a 17% reduction in the Fed's balance sheet. So will we hear QT with Powell? Perhaps. We may.
From a news conference with Chairman Powell,
So the spiders are just starting to come in a little bit. Let's look at this natural gas boil. It's still trying to... It did make a 30-minute bottoming tail intraday, and it's still closing inside of that. So clearly we can see it's getting bought back up. And look at this little bottoming tail potentially coming in. So you had your original one. You pierced that level, and now you're trying to close back inside of that. So we'll see. Our fifth ad level was the 620. You can see it missed it by a penny, which is too bad. It would have brought in our average nicely on this trade. But again, this is like natural gas. These are the levels you got to take it at. And I am comfortable holding natural gas overnight, even though it can still drop, say, 10% on you. But in terms of its decline, without any real meaningful buying pressure and bounce, I think we can still see this as a more depressed asset and money rotation, especially if we see the market sell off like tech. You could see the market trying to move money into more of the beaten down names because they'll likely fall less. Not saying like beaten down tech, but things like commodities that are beaten down extremely could see more of a bounce. Now I'm just going to tune you into Bloomberg. We have about 10 minutes. We'll watch Boyle. We'll watch the SPY. We'll watch Carvana for a short.
That statement was in line with what we were thinking in terms of, going 25 basis points this meeting, and then the need to do ongoing increases is pretty much what our economics team is forecasting for the Fed to go to a 5.25 type rate over time.
Greg, you've got a wonderful John Bogle view on your Vanguard note that if you miss the 30 best days going back a few years to 1928, you're wiped out. You don't get to play. How do our viewers and listeners get to play given the cacophony and noise of a Fed?
It's a great question, Tom. The reality is what we say to our investors that they need to stay fully invested at all times. And the point of that note was really the fact that if you miss the 30 best days, you're ultimately going to reduce 50% of your long-term returns. And we know it's unbelievably hard for investors to time markets. So for those investors, we just tell them to focus on the things that they can control, balance, diversification, making sure they're investing in funds that offer low fees to make sure they retain the majority of their earnings in the marketplace.
The heart of the problem problem here, and it's something Vanguard and others are known for, is you got to be in the market. And the basic feeling here is things are going to fall apart in a 78, 79 pre-Volcker way. We've ebbed away from that with a spectacular January. What does this Fed need to do to relink with a market that's moving away from their theories and policy?
Well, I think there's a couple of things. One, it boils down to fundamentals, and we know that the Federal Reserve is trying to get inflation under control, and they're doing a great job at that. You know, when we think about how we're looking at the economy going forward for the remainder of this year, you know, we're seeing inflation come down to 3% around that range at the end of this year. But that last mile from 3% to 2% is going to be a bit challenging, just given that's going to be driven more by what's happening in services. And so that's where we think there's going to be some challenges. And then when you think about the markets more broadly, when you look at valuations, bonds are back. You know, we're back to a place now where bonds are actually offering attractive yields. We're at a place now where even in money market funds, you're actually being paid to save money, where in the last decade, you were not being paid to do that. And so what we've been trying to counsel our clients on is the fact that don't leave money sitting in a bank account where it's earning 30 basis points at max, where you can sit there and invest in a money market fund where you're earning 4.3% or so.
Yeah.
That's real money.
We were talking about the market response to this somewhat, some would say hawkish, some would say in actuality dovish statement. There was a comment out on Twitter by an FX trader basically saying, right now, words mean very little from the Federal Reserve. Bonds know this, that the market basically is looking past anything the Fed will say. Is there anything that Fed Chair Jay Powell could say in, say, 8 minutes time that will catch your attention, that will make you shift your view?
I think a big part of it is really how he's thinking about the market more broadly. And when we look at financial conditions and the fact that they've eased up so much over the course of the last 6 months or so, if he were to come in and say something more aggressively than what the market's expecting. So again, our view is that there's going to be a couple more rate hikes, which is in line with the language. But if he were to say, you know, the market is way off base, I don't think that's going to necessarily be perceived well by the equity markets, which in our view still seem a bit stretched from our perspective.
So that's actually what I was going to ask next. Do you think that markets, the equity markets, have fully priced in a rate regime in the 4% handle, even 3.5%? Or are they still kind of working through the hangover of zero rates?
It feels to us that there's a lot of good news that's still being priced into the equity markets. I mean, when we look at our Vanguard Capital Markets model, you know, our projected returns over the next decade for U.S. equities is somewhere in the range of about 5.5%. When you look at U.S. bonds, our expected returns there over the next decade is about 4.5%.
So really, it's a non-event so far in the markets. Powell's clearly going to be the deciding factor, and really are not whether or not we're slowing down or what. But based on the data we got today, I think he still leans more on the hawkish side. But other than that, we'll have to obviously wait for his big announcement. That's going to be the deciding factor, whether or not these markets, I think, recover today, or if they continue to rally. You know, if you look at where we're trading on the levels, you know, we're on the potential verge of this breakout. Key gap up here. We could break out. But this could also be a bull trap, because a lot of people have piled in, and most of these rallies and float-ups have been on light volume. The buying pressure's come on light volume. So time will really tell. We're just waiting on standby, stuck in a range. And look how balanced that is. You whip down, you whipped up, and you're pretty much almost trading in the middle. So the dollar's peaking back up a little bit. You're seeing Carvana pump. So small caps are pumping. Bitcoin's just stuck at 23,000. Look at this pump on Carvana. Short squeeze in effect. Volume coming in. I do have a short level. High risk. This is extremely high risk. Whole bunch of little resistance points in there. We're not shorting Carvana yet. Don't even step in front of this thing. I mean, yeah, you can win it, but you can also rip your face off in 2 seconds. Let's keep an eye on the SPY. No movement, just stuck in a range. How about the Qs? The Qs have almost filled that. Oh, the Qs pretty much did fill that gap on the pop-up, so that's really interesting. So did the likes of Nvidia. Just going to scan through the oil charts. So oil's trying to sell off here, and so is UNG. I am going to pick up some BOIL here. At 618. That's the 5-6 position on BOIL. 618. Brings our average down to 644. So Powell's coming out here. The markets can react.
Good afternoon and welcome. My colleagues and I understand the hardship that high inflation is causing, and we are strongly committed to bringing inflation back down to our 2% goal. Over the past year, we've taken forceful actions to tighten the stance of monetary policy. We've covered a lot of ground, and the full effects of our rapid tightening so far are yet to be felt. Even so, we have more work to do. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of labor market conditions that benefit all. Today, the FOMC raised our policy interest rate